She grew up riding pump jacks in West Texas, served 5 years in the U.S. Navy on the USS Nimitz during Operation Iraqi Freedom. And today, she's helping high-income professionals build wealth faster through oil and gas investing that delivers both monthly cash flow and massive tax advantages. In this episode, Courtney Moeller joins us to break down how working interest in the right wells can offset W-2 income, multiply returns, and give investors a level of freedom that most people don't even know is possible. So, Courtney, thanks for joining us on Own the Exit. We're so glad that we were able to make this work.
Yes, I'm so honored to be here. So thank you for having me.
Well, hey, we've wanted for quite a while because Aaron and I have been personally investing in oil and gas for quite a while. And I know you and I met through a mastermind that we're both a part of. And this is your space. You are the resident expert in the oil and gas space. And so I'd love to kick off our conversation by hearing a little bit about your backstory and how you got to this place that you're at now, really helping folks eliminate their taxes and create cash flow and all that kind of stuff backed by strategic oil and gas acquisitions. So just give us a little background on you.
Yeah, and that's such a great question because raising capital for oil and gas was never on my bingo card. And so, I grew up in West Texas. And for those that don't know, Midland, where I'm from, is right smack in the heart of the Permian Basin, which is the number one oil and gas producing basin in the United States. Mm-hmm. And my dad was a petroleum engineer. My brother drilled oil. My uncle has a well servicing company. My sister actually drives water trucks for the oil and gas industry. So it's something my entire family has been a part of my whole life. And even when I was younger, we lived in Pakistan and Abu Dhabi where my father drilled. And then he drilled in Jakarta for 20 years before retiring. So gosh, I guess we lost him in 2011 and I inherited his company along with several thousand mineral acres in West Texas and things like that. And we've continued drilling with massive major oil and gas companies in the Permian. And it's funny because my investment journey, I was actually trying to figure out how to diversify into other assets because my entire portfolio was oil and gas. And through trying to figure out how do I make it to where my life is not susceptible to the price of oil, I found all of these other things. And so it's a fantastic space. I love oil and gas. If you can get in with the right kinds of deals and the right kinds of wells and the right kinds of operators, it's a fantastic space to be in. And I used to always listen to my dad and my brother talk about drilling, and we'd bring lunches and stuff to my brother when he'd be out drilling in Pecos and other places. And I never thought that this was the space that I was going to end up in, but I love it. And when I get those emails or text messages about what it's done for people's tax situations and things like that, it's super fulfilling. So
that's amazing. A couple of things you just said spurred some questions, but the first question is right now, we've actually talked a couple times on the show, had a few episodes where we've talked about the window of opportunity that's in the oil and gas investing space, both with massively increasing energy demands because of the rapid growth of AI. By 2030, AI data centers alone are going to be using more energy every year than the entire country of Japan consumes. And so there's obviously going to be a massive increase in energy demand, but I'd love to hear from your perspective on the ground. Why is, right now specifically 2025 an ideal window really from your perspective, an ideal window to be investing in the oil and gas space?
And this is such a great question because I find that typically if you look at the stock market and the trends in the market, it's really just a graph of emotions, right? People invest emotionally. And it was Warren Buffett said, buy when there's blood in the streets. And typically when everybody else is running away is when you want to move into something. Mm-hmm. And here when, Trump implemented tariffs and OPEC pulled their nonsense and oil prices dropped, everybody started getting scared. There was a lot of fear in a lot of the articles and the headlines that were coming out. Well, these operators are going out of business and it's not profitable anymore. And just so much craziness out there. And that might be true in some situations for some small operators, but really at the end of the day, what's happening is some of these smaller guys are getting priced out, which ultimately means we were already operating at a massive deficit of what needed to be created to meet demand. Demand continues to grow. Now that prices have dropped and you've taken more operators offline, that's less oil that's even being produced. At some point in time, we're going to slingshot back the other way. And because we do have lower oil prices right now, acquisitions are much cheaper. And so things that we were buying a year ago, which were offering about an 80% write off of your investment right now, because prices are lower and we're getting better prices, it's more like 90. So it's significantly better for investors. And the great thing is we might have to weather a little bit of lower oil prices, but eventually they're going to go back up. They're cyclical. They go up and down all the time. And it's funny because if you take a look at who's moving in, and don't pay attention to the headlines, but pay attention to what I call the smart money. What is the smart money doing? And over this last couple of years, Warren Buffett's acquired, I think, like $28 billion of Oxy. We have had countries like Abu Dhabi that are moving massively and moving massive amounts of money, billions of dollars into drilling here in the United States. We've got lots of other countries with their retirement plans, and all kinds of funds and money has been moving into U.S. drilling right now, which is interesting. And like I said, the demand continues to rise. I get the question all the time, well, aren't electric vehicles going to eliminate the need for oil? And the answer is no, absolutely not. I don't think that people, what they consider to be clean energy, it's really not clean. And actually, it's all very dependent upon oil. I think a windmill uses like 500,000 barrels of oil over its lifetime for lubrication. And don't even get me going on the amount of concrete, the oil that's needed for the concrete and everything else. So all of these other energies and industries that are even ahead of oil and gas are all very dependent upon oil and gas. And I think the other important thing to point out that some people don't realize is oil is not just fuel in your car. You've got about 42 gallons in a barrel of oil. These are really rough numbers, but about a third of that goes into gas for cars. About another third goes to diesel and jet fuel, and another third goes into products like plastic and asphalt, makeup, medical equipment, medicines. It is in absolutely everything, clothing. And I think sometimes people just don't realize that. And then a minute ago, you hit on something really big, and that's AI. And I can remember here a couple of years ago, there was a lot of upset about the demand the demand of energy that Bitcoin was needing to mine, because they were saying it was causing blackouts and all of these things. But AI and the amount of energy AI needs dwarfs Bitcoin. There's not even a comparison. And we are going to need a lot of natural gas to be able to fund these data centers and everything to fund AI. AI is not going to slow down. That demand is going to continue to increase. So I think it's a great time. It's a great time for acquisitions and prices. If you can get in with the right operators that have economies of scale and things like that, acquisition prices are really good. And I think you can't focus on what oil prices are in the short term. You really need to zoom out and look at the big picture.
Wow. Yeah. You mentioned a couple of times getting in kind of the right area, the right drilling, right operator. I think the operator, I always usually think in operations is the most important, no matter what asset class you're in. We always say the operations is better than even the deal, but both are important. What would you say to somebody who is wanting to get into this space? Like, how do you find a good operator? Because I think a lot of this stuff, people just at a high level, they might think, hey, this would want to be investing in this, but how do you take the step to do some diligence on that, or education, or what are your thoughts on somebody who's new to this?
Well, sure. And gosh, in the United States, we have like 50,000 oil and gas operators. It's a ridiculous amount of people that are out there drilling. It's significant. But in oil and gas, just like real estate, location and operator matter. They matter more than anything else out there. And whenever I am assessing a deal, I am only going to look at the top operators. And when I say that, I'm talking about Exxon and EOG and Continental Resources. These are billion and multi-billion dollar companies that are really good at what they do. And so if I come across a deal, and let's say EOG is going to drill 5 wells in Wyoming, I don't necessarily have to go in and do a whole lot of due diligence on their project because these guys have almost all the skin in the game. If it's $100 million to drill those 5 wells, they're going to fund probably 80% of that. And so we might come in as a small interest owner in that deal, but they've got almost all the skin in the game. They're funding that project. And these companies have the top of the line geologists and equipment and technology and everything else. So I don't have to do a whole lot of I don't need to check EOG's work. Let's just say that. It's just really more of a matter of, okay, what does the production in the area look like? What are we able to acquire it for? And that sort of thing. Of course, most of the oil and gas investments that you see out there are typically with smaller operators. And this is not a knock at small operators. I have a ton of friends that are operators. They're really good at what they do. But the difference in drilling with Exxon and then drilling with a smaller company is a lot of the smaller companies are really dependent upon raising all of the money for their projects. You know, you might be in a vertical well versus a horizontal well, and location matters. There are top proven basins in the United States. We've got the Permian Basin, the Bakken, the Eagle Ford, the Niobrara. I am never going to go and participate in a project that's drilling over in Georgia or Kentucky, or I'm sure they've got some oil over there, but I want to be in a proven basin in a top proven area, not only because we know that it already has oil and gas there, but it already has the piping and, you know, everything
infrastructure.
Else.
Yeah.
It's got the infrastructure to handle the oil and gas that is being produced when that happens, because those things matter as well.
Isn't there, even though because of probably the massive amount of activity in the Permian Basin, which you grew up around, right? Isn't there a challenge with capturing all the natural gas? There's like tons of flaring that has to happen specifically there because of even infrastructure in that basin, right? And one of the most developed basins in the world, probably.
Well, and location matters. And even in some instances, if gas prices are down to a certain point, it's cheaper just to flare it off than to try to get it and sell it. They'll actually lose money doing that. So it really just depends on the economics of what it's going to take to do that. And that's why we're actually seeing even more of kind of the Bitcoin mining equipment pop up with where some of them are drilling these wells because they're flaring off that natural gas. And these Bitcoin miners are saying, look, let me capture that natural gas and use it to power generators so they can run mining equipment. And now they're able to get Bitcoin that way. So you're seeing a lot more Bitcoin mining stepping out into the oil and gas space right now.
Wow, that's crazy because, you wouldn't connect those dots unless you were on the ground really paying attention. So, no, that's amazing. So I know a lot of our listeners are business owners making significant earned income off of their business, right? And so one of the big compelling things that Aaron and I as business owners love about the oil and gas space is the tax advantages that are able to offset earned income, not just passive gains. And so walk our listeners through what kind of tax advantages are available investing in an oil and gas deal.
Yeah. And this is probably one of the number one reasons people come to me is because they are high income earners, or they've got a capital gains problem. They've sold some stock or real estate and they're trying to offset it. And a lot of my personal investors are doctors or business owners or real estate professionals. I guess not real estate professionals, but, real estate syndicators and things like that. And so it's a very special asset class in that just by making the investment into the deal, you get to offset any kind of income with that. Active, W-2, passive capital gains. It will offset anything just by making the investment. You do not have to actively be involved. And it was something that was written into the IRS code a long time ago, more than 80 years ago, to incentivize people to go out and drill oil and gas. It used to be, it's still a risky asset, but it used to be much riskier before horizontal drilling came along, so it was an incentive that was put in place to say, okay, look, you might lose all your money drilling that well, but we're going to give you these really great tax benefits up front. And that way it's not a total loss. And it's stuck and it stayed in place. And the really other cool thing is not only do you get those tax benefits when you invest, but there's also something else called a depletion allowance, which means that the first 15% of that income every year is tax-free as well. So not only do you get that really great upfront tax benefit, but you get a tax benefit on the income. And I'm going to touch a little bit more on that offset because there's different investments out there that offer different amounts of that K1 loss in the year you invest. And it can be anywhere from 30% to 90% in that year. And so you always want to make sure if you're looking at an investment, what amount of your investment is going to the drilling costs, because the loss that you get in year one, those great tax benefits come from the intangible drilling costs. And those are things like fuel and labor that go into actually drilling those wells. And so if there's not as much money being allocated to drilling costs, maybe they're putting in Bitcoin mining machines. So they've got certain amounts of money going into buying miners or whatever. So that's going to cut into your K1 loss because it's less money that's going towards the drilling costs.
Right.
So that kind of will always give you an idea of where the money is going in the deal.
Like the act of drilling versus like some like currently producing wells, like because there's stuff for sale or you can invest in existing wells, but there's less there, right? You're saying for the tax benefits.
Your tax benefits are going to come from drilling new wells. If you're going to buy already producing wells, that is not going to offset active income.
Yeah. So if you're one of the risks, and I talk to folks all the time about this, and we have these conversations, one of the risks, obviously, there's different risks, but people have this idea, well, oil and gas is riskier than others. Like, no, it's not riskier. It's just a different risk profile. It's different things, different type of risk. But one of the risks that I hear from almost 100% of people when they're asking the question is dry well risk, right? Invest all that money and you don't hit oil, right? So with the operators that you're aligning with, talk us through how that risk is mitigated. And then if you've got the data of like some of the core operators you partner with, what is their kind of dry well percentage or batting average?
Well, and that's a good question, because that is typically what I see is people participate in a project and it'll just be either one vertical well that's being drilled, and it's almost like sticking a straw in this cup. If you hit that cup, then that's great. But if you were a little bit over to here, you're not going to get it. All of our wells that we participate in are horizontal. And so I actually just did a whole write-up on all of our projects, and we've had oil in every single one of our wells over this last couple of years that we've drilled. And I think we're on number 46 right now or something like that. And so, and my partner, who is a landman, he has done a little over 1,100 wells in this last, I think, 18 years. And they've only ever had 6 out of 1,100 that did not produce.
Wow.
And so the numbers have gotten much better. And part of that is because we are drilling horizontal wells. So our last set of wells was, I think, 2 miles vertical, and then it went another 3 miles horizontal. And so, and some of them are even, the total vertical depth on these things is 25,000 feet. That's significant. So not only are you going to be able to pick up whatever, let's say you do drill and you miss this pocket, but once you start going sideways, you're going to pick up that one, then you're going to pick up this one and this one, and for all of those miles that you went. So you drastically reduce the potential in a horizontal well of having a dry hole. And then you also increase the amount of recovery 2 to 7 times. So they are much more expensive to drill than vertical wells are, but the success rates in these top proven basins are 90% plus.
Yeah.
And you have all the geology and stuff too, right? Which it feels like there's been a lot of advances there where they know the proven undeveloped locations and stuff like that, where they're not just, well, we'll throw a horizontal here and there's probably oil.
Right. Yeah. That's not what we're doing.
Yeah.
You know, We are not. In most of our projects, I like to come in when they've already started drilling. A lot of the times they've either started drilling or they've finished drilling and we're waiting for them to come in and frack and complete the wells. Mm-hmm. And so by the time they get to that point, we already know we've got commercially producible oil in those wells anyway.
Yeah.
And so they're able to determine that during the drilling process, because if they get to that point and they're like, okay, we didn't hit what we needed to, they'll plug them and move on. They're not going to continue to spend money to frack and bring them online and all the other things.
Yeah.
And you were saying so it sounds like you inherited the business and continued to grow it and have some of your own companies, leases and things like that. And then you're also going into like putting funds together for other deals. Is it both? How does that work?
Yeah. So I still have my family business and we continue to drill throughout West Texas and things like that. So I have a combination of royalties where I'll just randomly get division orders and a big check in the mail one day. I didn't even know they were drilling. And so, but that's always a great surprise to find in your mailbox. And then the working interest that I own, they'll reach out and say, hey, we're going to drill X number of new wells with whatever company, and I can either opt to participate or not. And so that's really what that looks like. Now, the deals we were putting together, when I started working on this strategy a few years ago, I was trying to figure out, okay, if I'm going to drill, I want to drill with ConocoPhillips and Continental Resources and EOG and these major companies that are out there. The problem was that they're not out putting deals together and looking for public money. They're not raising capital to fund their deals in the way that we look at raising capital. And so I had to find a way to, how do I participate with these guys? Because if we're going to go drill, that's who I want to drill with. And so we just found a way, and essentially there will be, let's say John over here owns a 5% interest where ConocoPhillips is going to drill 5 wells. And I say, hey, John, I'd like to buy that 5% interest from you. And he's like, okay, here is what I'm willing to sell it to you for. And some people are willing to sell it and some people aren't, because obviously either they want to keep it, but a lot of people don't have once somebody's going to drill and you own a working interest, you're on the hook for those drilling costs. And so a lot of people don't have that kind of capital laying around to cover those kind of working interests. And some people are just flipping mineral rights just for the simple sake the government will go out and put mineral interests up for sale in this 100,000 acres of land for $250 an acre. And then let's say EOG is going to come in and drill a bunch of wells. Well, now, like real estate, the further along it gets developed, the more it's worth. Yeah. Well, it's the same thing with these wells. When you get raw land and nothing's going on there, you can get it for $250 an acre. But like the very first set of wells I bought, Anschutz had already drilled and we were waiting on them to complete. And I paid those guys $7,500 an acre. And so they made a ton of money on that flip. They weren't on the hook for the drilling costs and they're on to the next project. And it was great for me. I paid a lot more for it. And so obviously we're going to give up some of our upside because of that. But I knew I got an interest in 12 wells that had already been drilled. We were waiting for them to come online, and I knew we had good oil in all 12 of them. And so for me, minimizing that risk as much as possible is really important. And so I will pay more for those to be further along in the project to minimize that risk.
Yep. No, that makes a lot of sense. So we've talked tax advantage. We've talked kind of strategy, aligning with top level operators and how you do that. Now, obviously, the big question is, let's talk returns. Like, what should an investor looking at oil and gas, what should they, obviously, we think of investing from a risk adjusted perspective, right? So you want to get an asymmetric return for taking asymmetric risk. So what kind of return profile range should someone be expecting investing in oil and gas deals the way that you structure them?
Yeah, that's a really good question. So obviously the two things that we are susceptible to that I have zero control over is going to be the price of oil and then how well are those wells going to produce when they come online? Because the best geologists in the world can think, okay, I think they're going to do this, and they may or may not, which is why you should have multiple wells in your project. You don't want to ever invest in a deal that just has one.
Yeah.
And so obviously there's not a whole lot I can do about either one. So this is where that strategy comes in. But we're always going to target wells that are going to give us somewhere in a 2 to a 4x return. And that is very much going to be impacted by what the price of oil is doing. And so, but yeah, that's really typically about it. We're looking to try to get our investors their capital back within about a 24-month time period. And this is just a real generalization. It's about a 2-year time frame, and that's at about $72 oil. We kind of price everything out at $72 because if you take a look at many years of averages, the average price is $72. Even with prices dipping below zero during COVID and over 100, the average is 72. So I like to price it out at that. That's typically roughly about a 2-year return. And then it's another probably 2.5 to 3 years for another X, and another somewhere between 3 and 4 years after that for another X. So that's about what it's going to do. Yeah. These wells are going to produce probably 85% of what they're going to produce somewhere in like a 6 to an 8 year time frame. They might produce for 50 plus years, but you're going to get the big bulk of that within that less than 10 years.
Okay. So then 2 to 4x is your target over, you said maybe 3 to 4 years?
Yeah, well, I would say it's probably really safe, and this is where the price of oil really comes in. So if we've got really strong oil prices, we can return capital in 12 months. But if prices are lower, you're going to look at more like 2 years. If they're really low, fortunately, we've come back up. We hit lower 50s not too long ago, and we're back up. We've been floating between $65 and $70 here for just a little bit. So, which is great. But, even down in those 50s, we had some wells that came online January 1st, and we've averaged about a 3% monthly return, even with prices down in the 50s. So and it's funny because I've got experienced oil and gas people that are like, holy crap, this is amazing. My other oil and gas deals aren't even paying out anymore. And I have other people that are like, well, this is just not paying out very much. And so, but it's all about that perspective. And I'm actually really proud of the fact that oil dropped as low as it did. And we were still doing, I think the lowest distribution, we put in some jet pumps on a deal. I think it dropped down on $100,000 investment with that $52 oil is what I think it was, and an extra bill and a workover. And we still paid out, I think, $1,800 to that investor for that 1 month. So I was happy with that. They've fluctuated between that $1,800 and $4,000 since they came online in January. So it's been good.
That's awesome.
And then combining those with the tax benefits, right?
Yeah.
If you can go into something and get your money back in 2 or 3 years and then still have that same ownership percentage going forward to get the cash flow, and then the front end, I could see that being very attractive, especially for just high income earners, right?
Well, that deal we passed on, it was like 84.4, we'll call it 85% K1 loss. So if you invested $100,000, you got an $85,000 K1 loss. So let's say you make $500,000, that automatically takes your taxable income down to $415. So the year that you invest. So you get those tax benefits regardless. Those are guaranteed. And if you don't use them the year that you invest, they do roll over. And so
yeah, that's awesome. Are you able to model those on your deals too on the front end, or do you know, like, hey, we're thinking this is going to be like 80%, or is it just depends how much drilling they accomplish?
Yeah, we target that. We're not, and it's all about that acquisition price. We'll go in and take a look at, hey, it's going to cost us 20% of the AFE, and the AFEs are the amount that is allocated or what they're expecting the drilling cost to be. And so we won't ever go over 20% right now. While prices have been down, we have been acquiring stuff for like 11 and 12%, which has been really good, which is why we're closer to that 92% write off for the deals right now.
Wow.
Super cool.
That's amazing. Yeah, no, this is really insightful. And I think we've had a lot of our listeners that have been asking for more about the oil and gas investing space. That's why we're really excited to have you here. I think we'll move in now. We have a section of the show called the exit round. We ask every guest the same 5 questions and not related to oil and gas at all. So there's a little bit of a pivot here, but want to ask you these because you're the oil and gas queen, but you're also an entrepreneur and building a business. So we'll dive into these questions, answer them off the cuff. The first question.
I'm ready.
You're ready. You're excited.
I'm
okay,
ready.
Here we go.
Well, let me stretch.
There you go. These are easy kind of questions, but what's your all-time favorite business book?
Oh gosh. Okay. There's a whole bunch of them, but I will say my favorite and go-to is The Gap and the Gain. And as an entrepreneur, I was explaining to my son the other day, I feel like everybody sees this successful iceberg tip that sticks out above the water. But, beneath that surface, there's the grind and the failures and the ups and the downs. It's this roller coaster of a ride. And I think it's really easy to focus on the negatives instead of the positives. And The Gap and the Gain really talks about it doesn't matter how good or how bad the situation is. There's positive things and lessons to learn from every single bit of it. And just having that mind shift and being able to help me, because I've had really tough things that I've had to endure. It really helped me to focus and shift the being upset or focusing on went wrong and shifting it to, okay, this is what happened. What did I learn from it? How do I fix it? And how do I do better?
Yeah. No, that's really good.
All right. So next question. What percentage of your current income is fully passive versus active work?
Mine all is. My husband does have a W-2 job. He is a police officer. And so, gosh, all of my income has been nothing but passive income for more than a decade now, which is interesting. And my biggest goal here recently has been to diversify into other asset classes, because I always find myself, the tax benefits and the income are really addicting. And it's really hard sometimes to get excited about a $700 quarterly payment when I'm like, man, I can get this over here. So it's a little bit tough. So I find myself still ending up in oil and gas. But I would say if you combine both of our incomes, it's more than 50% is passive.
Okay.
Yeah, that's cool. That's the dream, right?
That's
for a lot
dream.
of investors. So
that's the dream. What's one thing that you wish that you could do more of, but your commitments to your business kind of hold you back?
I have gotten to a point now where I don't feel like my business commitments really hold me back. And there for the longest time, I wasn't very good at time management. And I had a lot of masterminds and meetups in the evenings. And I felt like my calendar was open to everybody anytime they wanted to book. And I felt like a slave to Zoom and my calendar. And gosh, about a year and a half ago, I said, you know what, evenings, I made them non-negotiable. I was like, I can't even remember the last time I'd had dinner with my family. And so I made evenings non-negotiable, and I started putting some parameters in place, and I'm still able to get everything done. I'm still able to have all the conversations that I need to have with the people I need to have them with. And then I'm able to actually still be present with my family and do the things. And having my own business, that's the one great thing that I love. We were just in Puerto Vallarta, a month and a half ago, and I was not home for an entire month because I have a baseball player, and we went from Puerto Vallarta to Alabama to Atlanta to Oklahoma playing baseball and traveling. And as long as I have a laptop and internet, I can do my business from anywhere. And so I'd be sitting out at Oklahoma University in the stands with great Wi-Fi, hosting meetings or conversations and doing what I needed to do. So I think I've just managed to build a business around my lifestyle that works.
Yeah, that's phenomenal. And that's the dream. Kudos to you.
Yeah, very cool. Courtney, so question number 4, if you could go back in time, what advice would you give to your younger self about building a business?
Oh, okay. Advice to my younger self. I guess probably the first thing would be to read Rich Dad, Poor Dad and join some financial and investing masterminds and groups. That would be number one. I feel like we're not taught a financial education. I feel like we're really bred and groomed to become cogs in other people's wheels and building other people's businesses. And I think there's a lot of other opportunity, and there's a lot of really cool strategies and ways to not only build wealth, but create time freedom and financial freedom. And now I'm trying to figure out how to teach it to my kids so they don't make the same mistakes I did. And I don't know if it would have made a huge difference when I was younger, but I wish I would have learned what I know now back then.
Yeah. Yeah, no, that's a good. So it seems like you've been able to create the time freedom and financial freedom. So this last question may be a little more nuanced, more of a how did you do it versus how are you trying to do it? But what's your strategy for creating time freedom and financial freedom for yourself?
Yeah, I never in a million years thought that I would be putting together oil and gas deals like that. And it's funny because here several years ago, I was asked to come and speak on a panel, and I actually didn't know who Robert Kiyosaki was, but they said, "Hey, we want you to come and speak on this panel with Robert Kiyosaki and G. Edward Griffin, who wrote Creature from Jekyll Island, and Peter Schiff, and this group of people." And I didn't know who any of these people were. And I'm Googling them and I'm like, oh gosh, like it was really intimidating. But it was that conference that I learned that people were pooling money together to buy assets. And I thought, God, that's brilliant. I'm a pretty smart girl. How did I never figure that out? And I thought I was going to be doing that to buy real estate, and then figured out that I don't know what a cap rate is and I don't know how to do all this stuff. So I'm going to just stick with what I know in oil and gas. And I love it. And I've been able to build a business around something that I grew up around, something that's been a part of my family and my family history. And I love what I do. And it's helping other people. So it's a win-win all the way around.
Yeah. That's phenomenal, Courtney. You're
very cool.
Your story is inspiring. What you're doing is remarkable, helping so many people be able to offset their earned income and make really great returns and passive income. It's phenomenal. How can our listeners get more connected with you? What's the best way for them to get in touch with you?
Yeah, well, if anybody wants to look more into the tax advantages, I do have an oil and gas report. It's at oilandgasreport.net. And then I'm on LinkedIn under Courtney Moeller, and my website's courtneymoeller.com.
Perfect. Thanks so much, Courtney. Thanks for being on The Exit.
Yeah.
Thanks so much for joining. Me. Yeah. Awesome.
No, you guys are awesome. What y'all are doing is fantastic.
No, we appreciate it, Courtney. All right. Thanks everybody for listening. We'll see you next time on The Exit.
See you next time. Yep.